Hello and welcome. Today we're going to tackle a really core accounting concept that answers a pretty simple question. How do companies show their earnings on these massive, multi-year projects? It's called recognizing revenue over time. And yeah, it sounds a little technical, but the idea behind it is actually surprisingly straightforward.
So let's just start with a thought experiment. A company is building a bridge. It's going to take 3 years. Should they report zero income for 2 years and then bam, this huge profit in year three? Or should they show their progress as they go? How you answer that question completely changes how you see that company's financial health.
So here's our game plan for today. First, we'll get into the why this is even a thing. Then we'll look at the two main ways accountants actually measure progress. We're going to put one of those methods to the test with our bridge project case study, and then we'll touch on the other way of doing things. And finally, we'll ask what happens when things get messy and you just don't know the outcome. Okay, let's dive right in. The first big idea we have to get our heads around is why we even have a special rule for this stuff in the first place.
The whole point is to create a more accurate, more honest financial picture. Think of a company's earnings report like a story. Instead of a story with two totally blank chapters and then this giant sudden ending, this method tells the story as it actually happens, year by year. It matches the revenue you report with the work you're actually doing. It just gives investors a much truer sense of how the company is performing over time.
So that naturally leads to the next question, right? If we're going to recognize revenue along the way, how in the world do we measure our progress? Accountants need consistent, reliable ways to do this, and it really comes down to two main schools of thought. We can measure progress based on either inputs or outputs. The input method looks inward. It's all about the company's effort, what they've spent in costs, labor, and resources. The output method, on the other hand, looks outward. It focuses on what the customer has actually gotten, the value they've received so far. So let's look a little closer at this input method. It really hones in on things you can count, things you can quantify, like costs, labor hours, and materials used. The logic is pretty simple. If a project is supposed to take, say, 1,000 hours, and you've already put in 200, well, you're about 20% done. Makes sense. And for those really big, complex projects, we're talking buildings, dams, or, yeah, our bridge. The most common way to do it is with the cost-to-cost method. It basically uses the money you've spent as the main yardstick for progress, and that's exactly what we're going to use in our case study. All right, theory time is over. Let's see the cost-to-cost method in action. Our bridge project case study is going to show us exactly how a company takes its real-world spending and turns it into the revenue and profit numbers you see on a financial statement. So, here's our setup. We've got a contract price of $2 million. Right from the start, the company figures it's going to cost them $1.2 million to get it all done, which leaves an expected profit of $800,000 over the whole 3 years. Okay, year one. The company spends $300,000. First thing we do is figure out the percentage of completion. That's the cost so far divided by the total expected cost. So $300K divided by $1.2 million, that gives us 25%. Now here's the magic. We apply that 25% to both the total revenue and the total cost. 25% of the $2 million contract price is $500,000 in revenue. And then 25% of the project's costs are recognized as cost of goods sold, which comes out to $300,000. And check out the result. By recognizing $500,000 in revenue against its $300,000 in costs, the company can report a gross profit of $200,000. Now think about that. The project is far from over, but the company can show its investors a healthy profit in the very first year because it accurately reflects the work they've already done. But of course, real-world projects almost never go exactly according to plan. At the end of year two, the company realizes, costs are running higher than we thought. The new total estimated cost is now $1.5 million. Now, this isn't an error. It's what's called a change in estimate. And the accounting rules just say we adjust for it as we move forward. No big deal. So in year two, our formula just adapts. By the end of that year, the company has spent a total of $900,000. We now divide that by our new estimated total cost of $1.5 million, which tells us the project is now 60% complete. We apply that 60% to the total contract price, subtract what we already recognized last year, and this updated math gives us a gross profit of $100,000 just for the work done in year two. And here it is, the full picture over all 3 years. You can see really clearly how the revenue and the profit are recognized in each period. So even with that change in estimate,
The total profit at the end is $550,000, but it's been spread across the life of the project. It gives investors that crucial year-by-year view of performance. So, that was the input method. It's all about effort. But what if we measure progress by focusing on the results, on what's actually been delivered to the customer? Well, that brings us to the alternative, the output method. The output method is all about value transfer. It asks the question, what has the customer actually received so far? This method directly measures the value that's been delivered, which, can sometimes be a much better representation of performance than just tracking how much you've spent. So what does an output actually look like? Well, it could be an engineering appraisal that says a certain piece of the work is officially done. It could be hitting specific milestones laid out in the contract. Or, for a manufacturing contract, it could be as simple as the number of units you've produced or delivered. A law firm is a perfect, super simple example of the output method. I mean, for a firm that's billing by the hour, the output is the legal service they provided. Since the client gets that value the second the work is done, the firm can recognize revenue for every single hour it has the right to bill. It's a really direct measure of value delivered. But what happens when things are so new or so unpredictable that you can't really use either the input or the output method? Well, accounting has a very conservative backup plan for that exact situation. Imagine our bridge builder is using some brand new cutting-edge construction technology. In that first year, they might have absolutely no reliable way to estimate the total cost or to even measure their true progress. So how do they account for all the money they've spent? The rule here is basically a safety net. It's designed to prevent companies from booking profits that are just pure speculation. If you can't measure your progress, but you do expect to at least break even, you recognize revenue only up to the amount of costs you've already spent. And then in effect, your reported profit is zero. So if we apply this to our bridge, and let's say progress was totally unknowable in year one, the company would report $300,000 in revenue to perfectly match its $300,000 in costs. The income statement would show zero profit. It just kicks the can down the road and defers any profit recognition until the company can actually make a reliable estimate. At the end of the day, all of these rules, they all serve one primary purpose: to make a company's financial story more honest by matching the performance they report with the progress they've actually made. The goal is to give everyone a clearer picture of a company's real health. So the next time you see a company reporting these smooth, consistent earnings on a really complex project, it leaves you with a critical question. Is that a sign of brilliant execution, or is it just the skillful application of accounting?